Hi, welcome to this video on how to set your investing goals. Investing is a great way to grow your money and achieve your financial objectives, but it requires more than just picking stocks or following tips. To increase your chances of success, you need to define your goals based on your needs, preferences, and constraints. In this video, I'll share some tips and examples to help you set realistic and meaningful investing goals.
Now that you have a sense of the possible investing goals, let's see how you can set them in a more concrete and personalized way. First, identify your priorities and constraints. Before you start investing, it's important to know what you value the most in life, what your financial situation is, and what risks and limitations you face. For example, you may prioritize safety over growth, have limited disposable income, or face tax implications. By understanding these factors, you can choose investments that align with your goals and constraints. Second, quantify your goals. To make your goals measurable and achievable, try to attach specific numbers and deadlines to them. For instance, instead of saying, "I want to save for retirement," say, "I want to save $1 million by age 65 with an average annual return of 7%, starting with $10,000 a year from now." This way, you can track your progress and adjust your strategy if needed. Third, estimate the required savings or returns. Once you have a target amount or income in mind, you can use some online calculators or financial models to estimate how much you need to save, invest, or earn to reach your goals. For example, you can use a retirement calculator that takes into account your age, income, expenses, inflation, and investment returns to see how much you need to contribute to your 401(k) IRA or other retirement accounts to meet your retirement income needs. Fourth, choose appropriate investments. Based on your goals and constraints, evaluate different investment options that can help you achieve the required savings or returns. These may include stocks, bonds, real estate, ETFs, mutual funds, and other assets that fit your risk tolerance, cost structure, liquidity, and diversification needs. Ideally, you should have a diversified portfolio that balances your risk and reward potential. Fifth, monitor and adjust your portfolio. Investing is not a set-it-and-forget-it activity. You should regularly review your portfolio's performance, fees, and risks, and adjust your allocation or strategy as needed. This may involve rebalancing your portfolio, selling underperforming assets, buying new opportunities, or considering tax implications. Now let's see some real-life examples of how people set their investing goals and achieve them.
Example 1. Jack is 35 and wants to save for his kids' education, which he estimates will cost $100,000 per child in 10 years. He plans to invest $5,000 per year in a 529 college savings plan, which offers tax-free growth and withdrawals for qualified education expenses. Jack chooses a diversified portfolio of stock and bond funds with moderate risk, aiming for an average annual return of 6%. Example 2. Sarah is 50 and wants to retire at 65 with a target income of $60,000 per year, adjusted for inflation. She currently has $500,000 saved in her IRA and $401,000 invested in a mix of stocks, bonds, and cash. Sarah uses a retirement calculator to determine that she needs to save at least $1 million to achieve her goal. She increases her contributions to her $401,000 and maxes out her catch-up contributions while also considering a Roth conversion to reduce her future tax burden. Example 3. Mark is 25 and wants to start building wealth by investing in stocks, but he is afraid of picking the wrong ones or losing money. He reads some investing books and blogs, joins a community of investors, and starts diversifying his stocks by sector and market cap. He uses a robo-advisor to automate his investing and rebalancing, and he tracks his portfolio's performance and fees using a spreadsheet. He aims to beat the S&P 500 index over the next 10 years, but also accepts that he may experience some volatility and setbacks along the way. So, there you have it. Setting your investing goals is a vital step in your financial journey and can make the difference between reaching your dreams or missing them by a mile. Take the time to define your priorities, crunch some numbers, and choose the right investments for you. And remember, investing is not a one-size-fits-all solution, but a dynamic and evolving process that requires discipline, patience, and knowledge. Thanks for watching, and see you in the next video.